Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and REITs have been dropping quite a bit over the past few days. They dropped by 5% on Thursday and another 5% now on Friday, and so they're down about 10% on average in just 2 days. And this includes even the biggest and best capitalized REITs in the world, like Realty Income, Public Storage, Digital Realty Trust. Prologis dropped by 10% in a single day, which is truly exceptional. And so if these high quality REITs are dropping so much, you can also imagine that a lot of the smaller, lesser known REITs are dropping even more. We had quite a few of them drop by 20 or even 30% in the most extreme cases in just 2 days. This was the sharpest crash in REIT share prices since the initial pandemic crash of 2020, and so naturally it's causing a lot of concerns. I've had a lot of you message me on YouTube, on X, on Seeking Alpha, Substack, and elsewhere, asking for my guidance to see what I think about the current environment, what am I buying. And so I wanted to film you a quick video on this topic. Unfortunately, I'm traveling right now. You can see in the background on the other side here the Venetian, a property owned by Vici Properties here in Las Vegas. And so since I'm traveling, I don't have my camera gear with me, but I'm filming this quick video on my laptop. And if you appreciate it, can you please show me your support and click the like button? That will help me a lot to keep producing this type of content for you. Thank you so much in advance. Let's get straight into it. So why did the market crash? And it's because President Trump issued some new tariffs that he put in place on most countries of the world, including its biggest trading partners like the European Union, China, Japan, really literally all its major trading partners. And the tariffs are very significant. They are about 10 times bigger than they were under his first administration. And the market thinks that this is very bad news for the economy. And I do as well. And that's why the market is crashing. It's going to increase prices for consumers in the US, as well as for all businesses in the US. So the profit margins will go down. It will likely also lead to retaliation from America's trading partners worldwide. And this is already starting to now happen. China has issued some major tariffs on American companies selling goods now to China. I think the rate is 34%. So we're just going to see less economic activity, it's going to be harder for American companies to sell their products to China, and whatever American companies and consumers buy from foreign countries is going to be more expensive in the US. And so the Trump administration is betting that this will lead to more manufacturing within the US, and so that this could in the long term benefit the American economy. But me personally, I'm quite pessimistic about that. I don't really see it happening, because the main problem here is that if companies were certain that these tariffs would remain in place for the long run, for decades to come, perhaps then we'll see much more manufacturing happen in the US. Companies would start building plants and make those major investments, but it takes really long to build those plants, 5 to 10 years. And the problem is that most companies are not confident that these tariffs will remain in place, and I'm not either. So far, Trump has already had a lot of tariff drama now with countries like Canada and Mexico. He would put some tariffs in place, and just a few days later he would remove them or delay them by a month or two. And there's been a lot of back and forth. And so this type of uncertainty puts significant doubt on what will really happen to these tariffs. And unless companies are certain that these tariffs will remain in place for the long run, they're not just going to start, completely reconfiguring their supply chains to shift manufacturing plants from countries like China to the US, because they know that perhaps in a month from now things will return back to normal, or at the latest at the next administration things will return back to normal. So I don't think that this will unfortunately work. And I'm not trying to be political here. I just don't think it's going to work, and the market is not buying into it at all. And that's why the market is crashing right now. And so prices are rightfully dropping. However, there is a silver lining, I think, here in REITs. And this is one of the reasons why I plan to keep accumulating more and more REITs. The long-term thesis doesn't really change for them. And in fact, I think they're becoming even more attractive relative to the rest of the market following the latest news. And that's because if we get a recession, this is likely going to bring interest rates to lower levels. And this will be very good news for REITs, because you may remember that REITs have now been in a bear market for 3 years. And the reason why they've been in a bear market is because interest rates have surged at an unprecedented pace. This has put a lot of pressure on the market sentiment of REITs. But if we now remove this reason why REITs are heavily discounted today, by dropping interest rates, REITs could strongly recover even if we go into a recession, because a lot of REITs are recession resistant. Think of things like cell towers or healthcare properties, affordable housing, farmland. Most property sectors are not so heavily impacted by recessions. Companies don't significantly change their real estate footprint based on a temporary recession. And even if they could, they're typically under long-term leases. And so they are not able to reconfigure their real estate footprint based on these short-term cycles. And so as a result, REITs typically keep earning highly consistent and predictable rental income even through recessions. As a result of this, they have also outperformed during most recessions in the past, suffering much lower downside than the S&P 500 and other sectors of the financial market. But they would benefit from rate cuts. And now we've already seen the 10-year Treasury come down significantly as a result of the recent announcement. Earlier this year, the 10-year Treasury was at about 5%. Now it has already dropped to below 4%. At the time I'm filming this, the 10-year Treasury is at 3.9%. So I think that this is very good news for the REIT market, and yet it's not yet reflected in the pricing of REITs. Everything crashed over the last few days. Capital pulled out of the market and it brought everything down with it, including companies that are not heavily impacted. But I think that as the market slowly digests this new environment, we'll see, I think that more investors will become more positive on REITs because of this specific reason that interest rates are now coming lower. I would also note here that the Fed has issued some remarks. Jerome Powell has said that they don't expect to cut interest rates in the near term since there's so much uncertainty about inflation. However, it should be noted here that the Fed has many times in the past said something and done the complete opposite, and the debt market is clearly not buying at all into what the Fed is saying here. It's predicting significant rate cuts now as a result of these latest announcements and the growing probability of us going into a recession. So that's the first piece of good news. But there are some other ones. Another one is that the tariffs will lead to much higher construction cost. This is bad news for REIT if they have significant development projects on the way. But most REITs earn, for the most part, their revenue from rental income. They're not developed. Development is not such a major part of their business, so they're not heavily impacted by that in that sense. However, it will lead to less supply, and less supply leads to faster rent growth. It also increases the replacement values of existing properties. And so this is good news for REITs as well. So, the tariffs overall, I think it's still a net negative. It's going to cause the economy to suffer, in my opinion. It's very negative for a lot of sectors of the financial market. But in the case of REITs, it's a bit of a mixed bag. Some REITs will suffer from it, but some others will benefit from it because it leads to lower interest rates and potentially higher rent growth in some specific property sectors. And so let's discuss now what are REITs that will suffer, what are REITs that will benefit from this, and finally what I think are some of the best opportunities to buy following this recent crash. Let's start with REITs to avoid. I think the main one would be hotel REITs. Hotel REITs are some of the most cyclical of the entire REIT market, and that's because they don't have long-term leases to protect their cash flow. People also travel less during recessions. They have less money to spend on traveling. I also think that an indirect consequence from these tariffs, and not just the tariffs, but some of the rhetoric coming from the Trump administration, is that we'll see less international traveling to the US. And we're already seeing it now with Canada. I recently saw a report that the advanced flight bookings from Canadians coming to the US are down 70%. And that's because of the tariffs, but also because Canadians want to boycott the US following some of the Trump administration's statements on Canada. And Canadians were not too happy about it. And I think that we're going to see something similar to a lesser degree also with Europeans traveling less to the US. Add to that a recession, and this is all very bad news for hotels. And on top of that, even generally speaking, I'm not a big fan of the hotel REIT sector because high capex, low margins, you are also the growing threat of Airbnb expanding, booking websites taking a bigger share of the revenue. It's just a tough sector. Also now with new technologies like Zoom, companies are traveling less. So yeah, it's a tough sector and valuations are very low. These REITs have dropped a lot. I mean, you look at companies like Host Hotels or Apple REIT or Park Hotel, they are all down very significantly, trade very low multiples of their cash flows, steep discount to the NAV, high dividend yields, but If we're going to a recession, we're going to see significant dividend cuts. There's going to be, I think, more pain before they eventually recover. And ultimately, the valuations, despite being low, are still not low enough relative to other more resilient property sectors. And so I'm staying away from hotel REITs. Other property sector I'm staying away is offices. I've stayed away from this property sector for a long time, and I think that this latest news only makes things worse for office REITs. Already now it has had a very significant problem because vacancy rates are the highest they've ever been at over 20%. The way companies use offices has changed following the pandemic, and while companies have returned to the office, they have, for the most part, gone into a hybrid work settings with employees working 1, 2, or even 3 days per week from home, and so this leads to less demand for office space, but also a different type of demand. They typically now want to be in the highest quality buildings instead of occupying a lot of space in lower quality buildings. They will occupy less in the better buildings, and so it leads to a very significant supply issue for the sector. And on top of that, if you now add a demand issue because of a recession, we're gonna see landlords suffer very significant pricing issues here. You're gonna see rents drop quite significantly, in my opinion, and I don't think that the valuations are low enough. What other property sectors would I avoid? Mortgage REITs, in my opinion, remain unattractive simply because they are too heavily reliant on unpredictable macro factors like interest rates and spreads that are difficult to predict. Inflation as well. A lot of them have exposure to development projects, which could suffer significantly. They could suffer significant losses simply because the construction costs now go up. And so if they face more defaults on their loans, you could see the market sentiment of these REITs suffer. I think this sector is too unpredictable for me, and so I'm not interested in it. I know that a lot of these REITs are very popular among retail investors. One of them is Arbor Realty Trust. It has a 15% dividend yield, but I have no interest in these REITs. I think that they're likely to cut their dividend in mass if things get tough. Industrial REITs are a bit of a mixed bag. I think that they're offering a great long-term investment opportunity because I think the demand picture long-term remains very positive, especially if you don't expect these tariffs to remain in place. I don't think they will. But the near term is very uncertain because they will be heavily impacted by these tariffs if they remain in place. So whether you're buying industrial REITs following this dip depends on your view if tariffs will remain in place, in my opinion. Okay, so what REITs would I buy? I think that the best REITs, in my opinion, in today's context with a potential recession in the near term, potentially higher inflation, significant uncertainty in general, will be the more defensive property sectors like healthcare, affordable housing, cell towers, things that are just not heavily impacted. Net lease REITs, well, I think that Vici Properties, which own this property there behind me, the Venetian, would do well because its leases have decades left on them. The rents are pre-agreed for the entire duration of the lease with annual rent escalations, and so the REIT is not going to be heavily impacted by a recession. It's going to even benefit if inflation accelerates because most of its leases have CPI-based rent adjustments. Its rental income didn't even change during the pandemic, which was the worst possible crisis for casino net lease REIT. And so if we go into a recession because of tariffs, I don't think that its rental income will change either. So Vici Properties will be interesting. Unfortunately for Vici Properties, not quite as cheap because the market understands this already. So I think there are some better opportunities if you want to be opportunistic here. And in my opinion, arguably the best opportunity right at this time as I film this would be Alexandria Real Estate, ticker symbol ARE. And the reason why I like it so much is because this is the leading REIT that specializes in life science properties. This is a healthcare property sector, so it's not really impacted by recessions. It's not very impacted by the tariffs either because pharmaceutical products have been exempt from the recent taxes. So it's not really impacted by these tariffs in that sense, and yet it dropped more than the rest of the REIT market of the past few days. It dropped by about 20%, even as other REITs dropped by 10%. And before this recent dip, it had already dropped very significantly. And so as a result of this, Alexandria is today priced at one of its lowest valuations ever. Its valuation is now on par with the great financial crisis. If you adjust for the lower leverage that it has today, its FFO multiple just around 8 times. And that's truly exceptionally low for a REIT of this quality. Historically, Alexandria has been perceived as a blue chip REIT because it has one of the best track records in the entire REIT sector. It has even outperformed companies like Berkshire Hathaway over the long run. It has one of the strongest balance sheets in the REIT sector. It has a BBB+ plus investment grade rating, low leverage with a 35% LTV, 13-year average debt terms. These are some of the longest debt terms in the whole REIT sector, so they're not heavily impacted by the surging interest rates either. They also own very high quality properties. These are Class A life science buildings. Over the long run, they have enjoyed some of the highest same property NOI growth in the whole REIT sector. I think that their 10-year average same property NOI growth has been 6% per year, which is truly exceptional for any property sector. And yet it's so heavily discounted today, in my opinion, because of two reasons. Firstly, it's associated with office REITs. There are no other life science REITs, and because of that, most investors tend to group Alexandria with office REITs simply because these properties look like offices from the outside, despite actually being very different, especially on the inside. The building characteristics of life science buildings are completely different, nothing to do with office buildings, and yet it's often, and the demand drivers also are very different, yet it's typically grouped with office REITs. Even any REIT, which is the REIT representative body, is grouping Alexandria with office REITs today. So this is the first reason. The second reason is that life science is today struggling, and the main reason for these struggles is that the sector is overbuilt at the moment. What happened following the pandemic is that suddenly companies were pouring a lot of money into the research and development of new drugs, understandably because of the pandemic. This resulted in very significant demand growth for life science space. Developers saw this opportunity to build new properties. On top of that, interest rates were super low. And on top of that, the office sector was struggling, and so a lot of landlords saw an opportunity to convert their office buildings into lab space. And so as a result of this, we saw a huge spike in new supply of life science space in 2023 and even more so in 2024. It put the sector in a state of oversupply, with occupancy rates dropping, rents dropping a bit as well. And so this has hurt the market sentiment of Alexandria, understandably so. It deserves to see its valuation multiple compress somewhat from it, but I just think that it saw its valuation multiple compress way too much, because what the market seems to fail to understand here is that cycles of oversupply are temporary in sectors that are enjoying growing long-term demand tailwinds. Real estate is cyclical. You always have it's nothing unusual to have cycles of oversupply, and those are then commonly followed by cycles of undersupply as developers eventually get hurt and scale back their projects. And this is already happening today. And so the new supply coming into the market in 2025 is expected to be way lower than in 2024. And it's expected to drop even further in 2026 because, again, developers have gotten hurt, construction costs has gone way up, interest rates as well. And so you just cannot build new life science space anymore today and make money on it. Most projects will be uneconomical. And so supply is now dropping, and eventually the demand will catch up to the supply. And I think that as this happens, we're going to see the market reprice Alexandria at a much higher valuation multiple than what it's currently trading at. Historically, this REIT has commonly trading at 20 to 25 times FFO, in some extreme cases even at closer to 30 times FFO, yet today it trades at just 8 times FFO, despite having the strongest balance sheet in its history and owning the best portfolio also in terms of average quality in its history. And so I think this is the classic mistake of the market overreacting to short-term negative news, extrapolating these recent trends far into the future, and not understanding really, that real estate should be valued based on decades of expected cash flow, and therefore 1 or 2 years of bad results really shouldn't justify such a significant repricing. Another topic that we recently discussed at High Yield Landlord, which is my REIT newsletter, is that I think that AI could very significantly benefit life science space over the long run, and this is a topic that the market has completely overlooked so far, in my opinion. If you want to learn more about this topic, by the way, you can join High Yield Landlord for a 2-week free trial. It will be the first link in the description of this video. This will give you immediate access to a report on Alexandria and how AI will lead to significant demand growth for life science space over the long run. I think that this is a piece of the puzzle that really makes Alexandria so much more compelling than the market understands today, because the market loves REITs like data center REITs because they benefit from AI growth, and yet it has overlooked that Alexandria is a hidden winner in the AI era. And so I think that as this also becomes clear to the market, we'll see a significant repricing to a higher multiple. But what else am I buying at the moment? I'm still thinking, I'm still working on my list. I think that Alexandra is one that I'm likely to buy more in the near term. There are a lot of other REITs. Another approach that you could take if you're a more aggressive investor is to now move into these more cyclical sectors, because those will of course suffer more if we go into a recession, but they have also sold off much more than the average because the market knows this, and in some cases the market has overreacted. As always, I will share all my transactions in real time with the members of High Yield Landlord. So if you want to be part of our community, you can join us for a 2-week free trial. Again, as I said earlier, there's a 2-week risk-free free trial in the description of this video. It will give you immediate access to my entire portfolio, all my transactions in real time, including the ones that I expect to post later this week. So that was my quick update for today, live from Las Vegas. Thank you very much for your interest. Let me know if you have any questions in the comment section below. Let me know what you think about this latest news, what rates you're buying. Thanks so much. Also, please, if you could click the like button, that will help me a lot. Thank you very much. At the next one. Bye-bye.